Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Thursday, April 14th, 2022. And in this one, we're just going to cover good old stocks and bonds. We'll start out with the stock market. I'm happy to be on this 5-minute chart. Just want to show you this for you active traders. I often refer to the 5-minute chart as being one of my favorite for very short-term trades. The technicals work the same way they do on a 60-minute, a daily, a weekly, even a monthly chart. They're just the moves that you're going to get are commensurate with the time frame. In other words, this is a little 5-minute chart. You can see all the lines on here. These are divergent highs, lows. That was a divergent low right there. You had a nice clean trend line, breakout and a back test, and there was a nice trade to be made. And again, it's a 5-minute chart, so you're not in it very long. You're talking that was the breakout occurred at about 2 p.m. on April 12th. And that same day, 7:50 on April 12th. So that evening, that run was over, and it was good for, if you bought the breakout or the breakout of the back test, about a quick 2.5% run. And again, you can see all the other divergent highs, divergent low, and trend lines and support and horizontal price support and resistance level. That was a divergent low right there. You had most recently this divergent high right here. Led to this pullback, and then if you zoom in nice and tight, you'll see the most recent little small bullish falling wedge on the 5-minute chart right there, right down to this support level here. That's 13,974 ish, and there was your little wedge, divergence, and pop. Now we already hit the first resistance level. That's a potential target. Active traders can take profits there, or you just put a stop and let it run, see if you can get up to the next level. I'm going to add a level right here, about the top of this consolidation zone. You can see we had a little bit of a consolidation there, followed by a breakdown, next leg down. So that's it. That's how the 5-minute chart works. Now, again, if you're not an active trader, this is not your thing. Then you want to look at the stick with the daily charts. Sometimes the 60-minute charts, they help time your entries and exits. That's what it looks like there. This is the same, wash, rinse, repeat stuff. You had this bullish falling wedge, breakout, rallied into resistance. I'm going to do this right now. I'm going to take this line and I'm going to move it up just a hair. That's where I had it before. It's now at 347.45. As I often say, the charts are dynamic, and so is my analysis and my trend lines and resistance levels. So before I had it right at the bottom of these lows, we popped a couple times above it. You can see now I have 1, 2, 3 candles there. So that's a resistance level as well as a potential target if you're swinging it up on the 60-minute time frame. You had that big old gap right there. We got halfway through it and then rejected. That's 3 candlestick rejections on the 60-minute time frame there. So that's what that looks like. When we jump out to the daily chart, nothing much has changed in a while. You can see we've been really consolidating for the last 4 days here in this area. And so that's where swing traders need to be patient. They get frustrated when you get these little back and forths. But again, active traders can zoom on down to those shorter term charts and trade the little micro squiggles, I call them, little rips and dips. There's still a gap to be backfilled, and I could certainly add some more levels to this chart. I have different boards, but there's that top of the gap from last week right there, which would come in as resistance if we get a full backfill the gap. And then, of course, anytime you have an area of consolidation, you look at the recent lows right about there, and if we take that out, then that would most likely continue down. If you look at it this way, that's also a potential bear flag. You have, as I've drawn it out here, let me turn off all the other lines. You have an impulsive leg down, that's a flagpole, followed by a level of consolidation. Ideally, you want to see declining volume on a bear flag pattern. That's what you see. It's a consolidation pattern. So if you break to the downside, what you'd look for is an impulsive breakout of the down below the flag on increasing volume, and that would be your sell signal there. And then your measured target, you take the length of the flagpole, and in this case, you could either do right here. It's going to turn on all my lines if I do that. Let me use a drawing tool. I was trying to take the line tool there so I could replicate it. You could either take that as your flagpole, that's a little more conservative, or you could start from that point and then you'd add it to the top of the flag, and that would take us down Again, I'm just hand drawing this. I didn't make a parallel line. Just take a trend line and either move it or create a parallel line and add it down there. And again, that's just a measured target that would take us down there. But right now, the bigger picture is, near term we're consolidating. That flag may or may not play out. But we're below all the key moving averages. That's the most important thing. When I look at the daily chart, we took out the 200-day moving averages here, back tested them a couple times, failed, followed by a pretty impulsive rejection. And again, we spent about nearly a week back testing again and another rejection. So that is puts the markets, keeps the markets in a bearish technical posture, which they've been in really since we took out the 200 days there. And you've had multiple shorting ops. If you didn't short those sell signals and the bounce backs to resistance we had back here, if you back late last year, early this year, then these were your ideal swing trend trader short entries there. And again, like I said, you just have to be patient. If you are holding out for the prize, and the prize being the bigger charts, the bigger targets on my weekly chart, which is and remains and haven't changed. Got T2 still about 299 to 300. T3 is about 268.30. You also have a couple trend lines that come in there. So if we get down there, those will probably come into play around the same time. And then my max target at this point in time, where I'd be looking to most likely pretty aggressively reverse from swing and trend positions from short to long at that point. And that would be the pretty much that what I call the pre-COVID highs from February of 2020, just before COVID took hold of the markets. But these are pretty significant levels along the way where we would probably see reactions if they're going to be hit. And now the biggest picture, that's my weekly chart. You can see those trend lines, by the way, that I showed you there are the ones off the what I consider the bull market lows, even though technically that was a bear market and that was a drop. A couple of these were drops of 20% or more from high to low in the NASDAQ 100, but they were just corrections in this ongoing bull market that started back in 2008, 2009. That's when the Fed started raining money, free money, zero interest rate policy, and tried to take it back there a couple times. The market squawked, and they reversed course after going from dovish to hawkish. Never really got very far on rates, but this time around we all know it's different. They are boxed in a corner. And I'm going to show you something here. We're going to go out to the longest term charts I like to use, the monthly charts. And again, this might be a recap for some. I've covered this chart many times in the past. For those of you new to the site, what I have here are it's a very simple and effective indicator. There's two trend indicators you can see on this chart. One is this 20 period exponential moving average. So it's a monthly chart, so 20 period monthly moving average, and it does a phenomenal job in my opinion. I give it a 10 on a scale 1 to 10 for indicators. It gets a 10. I put two weightings into effectiveness of any indicator. Number one is how accurate it is, of course. That's a very important criteria. But then also simplicity, because you can get a lot of moving parts, a lot of different indicators. And this one is pretty simple stuff. When the market is above, or in this case the NASDAQ 100 is above the 20-month, the trend is bullish. And like any, it works as support or resistance. It tells you the trend's bullish, and it tells you can buy pullbacks to that level. If you zoom in nice and tight, you'll see you had multiple pullbacks, and they were all proved to be, the start of the next leg up. And then when you take it out, you want to see, of course, it's a monthly chart, so you have to see a monthly close below it, and that's what you had back there. That was, we're looking at decades of price action here. So now you're looking at the that was the dot-com bubble right there. The bubble popped, market peaked back in early 2000, and then this indicator told you finally right here on this candle, that was the month of November, you had a solid close, an unmistakable sell signal. And again, if it's not going to get you in right at the top, it's not going to get you out at the bottom, but it captures the bulk of bull and bear markets. And if you missed the signal there because you were waiting for confirmation on a monthly time frame, you didn't want to jump the gun, well, you had a beautiful back test of it, a perfect back test right there. I think you can see that candle in the video the following month, the monthly candle, just some point in December that would have been. And that was it. We had a back test and never looked back. And if you shorted that back test and just tucked it away, you made 73% on your money. That's how much the NASDAQ 100 fell. To the bottom, and that's playing the high and low game. But what gets you in early and out of a short position earlier are those shorter term charts. We'll look for the same kind of things, divergences, trend indicators there. And so this is more of, let's just say your 401k type money. You want to be long in bullish equities when you're above that. Works as well in the S&P 500, and then out of the market or short when you're below it. And then you can see, so that ended that bear market, started a new bull market here, and then you just kept, all these pullbacks. And it was a whipsaw. Nothing's perfect. It's like I say, I'll still give it a 10 because there's not a perfect indicator out there. If there was, we'd all be using it. Everybody would be rich, but it wouldn't work because if everyone's using the same indicator, it's not going to work. All right, so that's that. Again, you had a whipsaw, but you regained it the following month. You closed right back on it, and then boom, boom, boom. So there it is. And here's, there was a top, that 2007 to 2009 bear market right there. You went through it, and yeah, there were a couple whipsaws, but finally, once it was clear you lost it, and right there, boom, there was the big final leg in that bear market. And really, since then, this is the current bull market again. In the NASDAQ 100, it started in November of '08. Every other index, small caps, large caps, mid caps, S&P 500, all those started in March of '09. So here, effectively, we call it a double bottom. And boom, that was it. You regained that 20-month right here. And all we've done all along, and these are intra-month breaks, only to close back above it. So we've had almost zero whipsaws. You had a slight close below it there in that big fourth quarter 2018 drop. Even when COVID hit, you never closed below it. You had a big intramonth dip when COVID first took hold of the markets in March of 2020. But only to close back above the 20-month and then well above it the following month. And now here we are. So this is big picture stuff. So, you can't say with any degree of certainty yet. You can't call this a bear market, even though the NASDAQ 100's already dropped 22% high to low. To me, that's just a correction back to the 200 days. So now, where I'm going with this, I've covered that many times. I'm going to show you something here in just a second, and also mention that the other indicator on this chart, and that's where all these numbers are for right here, they show you the drops associated with another very simple but highly effective indicator, and that is the PPO histogram. The histogram on a PPO or a MACD, PPO is much better in my opinion on this long-term chart than a MACD. It shows you when the MACD lines cross. They make bullish and bearish crossovers. That's what's represented by the histogram. And the farther apart the lines are, the farther higher or lower the histogram bars are. That's all it is. Just showing you the differential between the two lines. That's what a histogram shows you. So red to green. Green is bullish. And again, another pretty effective indicator. With almost no whipsaws, very few if any, and all these it's hard, I know, to see in the video. There was a little red crossover there, there was another one there, and these show you all the drops associated from high to low that occurred when you had these crossovers, and most of them were just corrections, about 20, 29, 18, 16, 13, 26, 24, 31%. Again, a correction, what I call it, when COVID hit. The S&P fell 36%, but NASDAQ only about 31 high to low. And then, of course, it also, so it not only captured those corrections and told you each one was associated with that, but more importantly, so were the bear markets. So, one of these corrections, sooner or later, is going to start out being a correction. This one was 22% so far, but it will ultimately morph into the next bear market. And that bear market in the NASDAQ 100 was 84% drop from high to low. The one that hit in 2007 to 2009 was a 55% drop. So that's why I have up here question mark, 22% roughly drop. And so what we know that we're still red. So this trend indicator, the histogram trend indicator, is still bearish, but yet we're still above the 20-month moving average after 1, 2, 3, now 4 consecutive months testing it. Okay, so you can make the case, absolutely, if you are a bull, because you've been rewarded for over a decade now buying pullbacks to the 20-month. And maybe that continues. But with your 401k money, in long-term money, or if you're a long-term trend investor, you want to be on the lookout for a monthly break. Usually, when you get that solid monthly break, it's by the time the monthly candle's printed, you're pretty well below there. Again, just something to watch. Is this possible? Absolutely. Anything's possible. I don't need to tell you that. That's just a given. But what is different this time? So we look at this chart, and let's just, even in recent years with the bull market, let's just talk about that. Again, I'm saying 2009 to 2000, early '08. I'm sorry, early '09 to current is a bull market. But we had a couple in that bull market, some of the bigger corrections here, 31%, 24. That 26 high to low, by the way, was a flash crash in QQQ. QQQ is not the NASDAQ 100. It's an instrument, a derivative. One instrument that tracks, is a way to trade another. If you can't buy the NASDAQ 100 directly, you could buy all 100 stocks if you want, but you buy an ETF that tracks it, which is this, a mutual fund. You can buy futures, you can buy options, things like that. But where I'm going is the ETFs. That one there was, and I was trading at the time, a little mini crash. So the Nasdaq 100 fell a little less than that, but it was still a decent correction. But that was the high to low drop in the Nasdaq 100. But let's focus on the most recent, COVID, and then the Q4 '18. This is when the Fed made a pivot. They started going hawkish, started a rate hiking cycle that didn't go very far because, as I predicted, and it happened, the market turned around through a hissy fit in the fourth quarter 2018, had a big drop, telling the Fed, the spoiled kid, meaning the stock market, cried, and then Uncle Powell, or was it Yellen back at the time? I'm trying to recall. The Fed turned around in reverse course, did a complete 180 pivot. Said, okay, you want the zero, you want the juice, we'll give it back to you, and then the market resumed. All right, so that's what happened. Now, the point of this, let's talk about what happened then as well. So the market likes low rates. I'm going to use the 10-year bond and show you that something I've talked about many times in the past. This is the bond yield, not bond prices. Shows you what the 10-year bond yield has done for decades. We're going back into the 60s here, and we were in a rising rate environment, and then at the time up until now, the hottest inflationary environment that we've had, and it's been 40 years now. That was in the late 70s, early 80s. Inflation was rampant, rates were high. Fed was keeping rates high to try to curtail inflation, and then it peaked there in the early 80s. Think outgoing Carter, incoming Reagan. That was around that time, and since then we've been in one of the strongest secular bear market in interest rates, which is a bull market in bonds. Remember, when rates go down, bonds go up. So interest rates have been falling. And if you just study this chart, as I just talked about, so we know the biggest drops that we've had in recent years were obviously when COVID hit. That's when the Fed just pulled the all-out nuclear response. I mean, everyone thought what they did, including me back in 2008, was extreme, and it was at the time. It was the biggest, unprecedented. But what they did in 2020 just made it, with a combination of both fiscal stimulus from the Fed and monetary stimulus and fiscal stimulus from the government. Monetary stimulus from the Fed, it was again considered a nuclear reaction. Obviously, they overstimulated. But here's where I'm at. Okay, so we know rates exploded up, and that helped the market. Rates. This is again TNX. I'm sorry. This is it right here. Where am I missing here? This is the drop off right here. When you zoom in, this is the drop in rates. That's what I was saying when they did that. They pulled out, and rates. They took rates down to the floor. They don't control the 10-year. They don't control the 30. They control the overnight rates. But that, in turn, they also had a lot of shenanigans, bond buying programs, things like that, to bring long-term rates down as well. And they did that, and they accomplished it. So that saved the market. The market's got another injection of the juice over low interest rates and an uber dovish Fed, about as dovish as they could get. And since then, that's been obviously the inflation trade hit back in the fourth quarter of 2018, which is right here at the end of 2018. Rates were going up, and that's when the Fed did the pivot. They were trying to raise rates, trying to walk back their easy money policies implemented back in '08, but then boom, gave the market back what it wanted when it threw a hissy fit, as I just showed you. That's what's finally staved off or ended that 30+% drop right there. Or I'm sorry, 20-something percent drop back in the fourth quarter of 2018. So again, you can see the drops in rates. And you go back in time and the same thing. You'll see when there's a volatility in the stock market, they've called it the Fed put. It's been in existence now for 4 decades, over 40 years. But what's different this time is we all know the Fed was prone to what's known as recency bias, figuring, hey, we printed a crap load of money back in '08, took rates down, stimulated the economy. We've done it several times since. We've been at near zero rates for over a decade now, and inflation has not been an issue. And so they assumed that that would happen continually. And they underestimated. Finally, it was a flashpoint. That's what I talked about for years. When inflation finally hit that flashpoint, especially with everything they did. And it was, I don't need to tell you. Read the headlines where, you know, the rate of inflation right now, the rate it's increasing and how rapidly is much faster than it was back then. We're not at the same interest rates back then, but so that's what's happened. So, all right, where am I going with this? They have now pretty much used up every arrow in their quiver. And so here's the thing. I do expect a pullback in rates, but the Fed can't do much. I think we're looking at the 10-year. Remember that. The Fed's going to continue to hike. You can see the short end of the yield curve continue to rise. But I do believe at this point in time, as I mentioned the other day, I put out a post out on Monday, I believe it was, showing you a long trade ideas on Treasury bonds, because remember, bond prices go inverse to rates. So bond prices have been falling at the sharpest rate they've ever done in decades, of maybe and ever. But we have now hit that long-term downtrend line. I do think over time, I think the cyclical bear market in rates is over, and I do believe this trend line will be broken. But what I believe is that usually if you have such a strong move to get up to a resistance level, such a well-defined resistance level, again, we're talking a multi-decade long, 40-plus year downtrend line, the odds of just blasting through there and continuing on is very slim. Maybe you break out and back test it. There's also some horizontal resistance right ahead. But where I'm going, I think the risk reward for bonds right now to be long, particularly in government bonds, is as good as I've seen it in a while. And it's more of a, for me, it's a a tactical trade. It's not something I plan to be in for 3 or 4 years. But even maybe some 401k funds, if you've had it in cash lately or something, shift some over. I think near term, again, the risk reward says we'll probably get a pullback in rates, which would be bullish in bonds. Again, we're at resistance on the 10-year. Here's the 30-year. And again, this is TYX, the 30-year Treasury bond yield. Look at that. We're almost there. Not there. So there's a potential for a little hair more upside, but not much in the 30-year. And again, that's that price channel going back all the way into the late 70s, early 80s right there when rates peaked. And there's the nuclear response from the Fed, and then the reversion to the mean that followed. And so yes, I do believe over time we break out and we start a new secular bull market in rates due to all the inflation. But what I think will happen, okay, so that's all technically the charts that we're at the resistance. What I think is going to happen fundamentally is the rising rates, the withdrawal of all the fiscal stimulus that we've had and all that, we're probably going to see, or almost certainly going to see, growth slow. And whether it leads to a full-blown recession or a bad one or a mild one, that's going to bring down long-term rates most likely, because if long-term rates go up on both growth and inflation expectations, they typically go hand in hand. The hotter an economy is, the stronger the growth, typically the more inflation you have. So it is completely possible to see the Fed continue their rate hiking process. We'll probably almost certainly, I think, get a 50 basis point. I haven't looked at the odds recently. You can get them online. Just Google Fed Fund future probability, and you'll get a chart, and it'll tell you how much it's priced in. Last I checked, I think they're priced in at a 50% hike at the 50 basis point hike at the next meeting. But and so the Fed can continue to raise, but most of that's been priced in, especially on the short end. That's why I told you guys overweighted on short-term bonds right now, the 5-year more than the 30-year. And so what'll happen is, I think soon, as economic growth expectations fall, so will inflation expectations, and then you will get probably at least one more pullback in interest rates, which gives you a tradable bounce in bonds, being long. Remember, when rates go down, bonds go up, and then ultimately break out, probably start our new, or maybe we stay in a in a sideways trading range. It's hard to predict when this will break out. And I can't say with 100% certainty we just can't keep going through there, but I can tell you with a strong degree of probability that's not going to happen, that we're just going to blast on through there. Anything more than a brief or marginal breakout without some consolidation around such a significant trend line. And then there is the 5-year. I showed you started with the 10, that was the 30, and here's the 5-year, and there it is at the same long-term 40-plus year downtrend line right there, and that's it. And it's been a heck of a stretch just to get there. So to say that interest rates are overbought, or to flip it around the other way, and you look at the bonds themselves, IEI is the tracks the 5-year bond. To say that it's oversold would be an understatement. So again, you want to go long bonds if you believe that their rates are going to pull back. And you can see we're at an extreme reading on this week. This is a weekly chart of about 16 on the RSI. IEI is only traded since 2000, early 07. You can go back longer on TLT, I believe. TLT has been around. That hit the market back in 2002. And you can see that TLT, we have positive, aka bullish divergence on this weekly chart. The last time that we had bullish divergence on the weekly chart was right here. And from that point, you had one of the strongest moves in history. And again, that was aided. It was technically induced. We came back to a major downtrend line. So, I used to find it uncanny. I've just now come to accept it, that the charts, the technicals, and the fundamentals align in so many ways. It's just hard to understand. You just have to take it on faith that it wasn't mere coincidence. That's when rates started going up. But there's where the COVID hit, and that was the final blow off top. But there was a nice bullish falling wedge. It was pointed out at the time. Pull back to support, and we're at that same trend line right now in TLT. And you have positive divergence. It's not yet confirmed. We need to turn up soon to keep that divergence intact. And like I said, we could overshoot it, and I'd be fine overshooting the trend line because I think we'll come in and back test it. So, again, when I told you a week or so ago wasn't hard buys, but they were more hard buys recently because we broke out of those 60-minute wedges. So there's TLT, again, trade idea for you. There's our divergence line. And then IEF, if you want a little less volatility, the shorter you go in maturity, the less volatile the bonds are. You have good support down here. So if we continue to go down a little more, that's fine. But I showed you the 10-year and the 30 and the 5-year at major downtrend line resistance. So we may or may not get there. If we do, IEF, that's about to the top of the support zone is about 2%, and to the bottom is about 3.5. So that's about the max downside I see on the 10-year bond right now, 2 to 3%. So the risk reward is attractive, in my opinion, to start scaling into bonds right now. And again, like I said, as far as the stock market goes, because of the runaway inflation, the Fed just does not have. It is not even an option. Nobody out there considers it an option that the Fed's going to come back in and cut rates at this point in time. It's clearly a matter of how fast they're going to raise them and how much they're going to raise them. That's been well announced. And this is not the Fed of yesteryear. For over a decade now, well over a decade, the Fed has believed in telegraphing and not surprising the market, telegraphing well in advance what they're going to do. So they're not going to pivot without a slow pivot. And so that's it. So the bottom line is the stock market, as I began the video, from a swing or longer term trend perspective, it's still above the key, gave you some key levels, 40-week moving average. And again, you want to keep it simple on QQQ and SPY as well, IWM, all of them. Just really look at the recent lows. That's what you need to take out. You take out the recent lows, then you're also going to have taken out the the 20-month exponential moving average. And although it is possible to see another stick save, what that means is, again, we're April 14th today, so we're halfway through the month. You could break it and then close back above it, but we've already taken it out twice on an intramonth basis. Usually that's about it. You do that, and it's usually you're either going to hold the line and rally, or you're going to break it. And if you break it, there's your targets. And I still expect that it will be broken. So you just can't. Hard to be very aggressively short now. If you want to, just manage your positions if it goes the other way. But like I said, right now there's that potential flagging action. We can watch that. You can trade the 5-minute charts if you want, or just as a trend or swing trader, focus on the 60-minute chart, daily, weekly, and even the monthly charts that I covered in this video. So that's it. So to summarize it, I remain from an intermediate term perspective. That means weeks to months out, still bearish equities, and near term right now, bullish Treasury bonds. Not so much corporates. They may bounce as well, but remember, if you start seeing increased expectations for a downturn or a recession in the economy, what that does is you have a credit quality component to corporate bonds, and you have a lot of investment grade bonds, AAA, AA, single A rated, triple B even, that get downgraded. And so corporate bonds are not only affected by current interest rates and future growth expectations and rate expectations, but corporate bonds are much more impacted by the economic cycle, whereas government bonds, government's going to keep taxing us and pay the bills. So it's rare to see. It has happened where the U.S. has been knocked down off that AAA credit rating, but for the most part, credit quality is not, or at least up until this point in time, hasn't really been much of a concern on U.S. Treasury bonds. But we've got a pretty big fat deficit. We got a lot of IOUs to pay for going forward, and we got a lot of big countries out there, Russia, China, that are big holders of U.S. Treasury bonds that don't like us as much as they used to. So anything's possible. Just that's all I'm saying is don't discount the fact that you could see, and we've probably already seen, mass dumping of U.S. Treasury bonds, in addition to the Fed unwinding their bond purchasing program. So anything's possible, so don't get married to any trade, whether it's bonds, stocks. And at the end of it, I just covered 2 asset classes, stocks and bonds, but I like to spread out and cover most points in time, trade all of them. Commodities are another asset class. Precious metals, you can consider their own. Real estate, REITs, things like that. So and that way you're going to be right on one or two, hopefully right on as many as you can be on your positions. And if you're wrong on one or two at any point in time, or even on the whole call, you get stopped out, well, you're hopefully firing on other cylinders. That's the whole point of diversification and asset allocation. All right, I want to wrap it up here. This has been Randy Finney with the Right Side of the Chart. Have a great day.